Today is the 11th of January 2022. Happy New Year, everybody. I hope that you've had a better year than most of the stock markets around the world. My name is David Hickson, and in today's market update, I'm going to be taking a look at the S&P 500 and also at Bitcoin, because both of those instruments have been displaying some quite interesting cycle shapes, which are worth looking at. So let's start with the S&P 500. In fact, this is a slightly different chart to the chart that you've been looking at in recent market update videos, because I'm working with a different data source. I'm working with Yahoo Finance data. So the bars you might notice are only displaying regular trading hours. Normally I like to work with data that includes as much time trading as possible. So I normally work with data that trades after hours as well, but in this case this is only regular trading hours, so it might look ever so slightly different, but nevertheless it is for the same instrument. And so the analysis we're looking at is the same as the analysis that I've looked at in recent market updates. This is the analysis with the 18-month cycle trough here at the beginning of October, as I have discussed in previous market update videos. There is also still the possibility that the 18-month cycle trough occurred in July, which would then make this trough in early December a 20-week cycle trough instead of an 80-day cycle trough. But I've discussed those possibilities in previous market update videos, so I'm not going to go through all of that again, because I have some other things that I would like to speak about. But you should be aware that that possibility of the 18-month cycle trough in July is still, it's possible, it is still valid. This is at the moment my preferred analysis, and perhaps what I should do actually is zoom out just for a moment to give you the bigger picture. So here you can see the 18-month cycle trough at a position which is clearly the most prominent trough position in my opinion. But you can see I have had to influence the analysis. That is what this pin symbol is at the foot of the chart. I've had to influence Sentient Trader's analysis by asking it to position the 18-month cycle trough there, which it has done. It results in a fairly long 40-week cycle over here, with the trough at the beginning of March, but that is also something I've discussed in previous market update videos. Speaking of which, if you have not been keeping up to date with these market update videos, I would encourage you to watch them, because I try not to repeat myself too much in these videos. So I am sure you would benefit from taking a look at the previous market update videos. I'd just like to point something out. This 18-month cycle trough in this position in October measures 561 days. The average length of an 18-month cycle is 546 days, so that was only 15 days late. So that is another reason why I think that's a very good position for that 18-month cycle trough. You can see from the bar count at the right hand side of the screen here that 658 bars have elapsed since that trough in March of 2020. I know there are some analysts that are still watching analyses which have an 18-month cycle trough still lying ahead of us. Not impossible, but in my opinion it is less likely than the analysis that we are looking at here. So let's get to the point of the video, which has to do with the cycle shapes. And so let me explain what I mean by cycle shapes. Cycles influence prices to move up and down, and the result of their influence can be recognized as an M shape in the markets. So of course that's an M shape, a capital M. So we have two peaks in any M shape, and we have a central trough. And the result of the cycle's influence is that you are pretty much always able to identify an M shape in the markets. Sometimes it can be a very stretched and distorted M shape. So let's quickly draw the M shape, or the cycle shape, for this 80-day cycle, starting from the trough in October up to the trough in December. So we first of all have a move up for the first part of the M shape. The central trough of the M shape should theoretically be where the 40-day cycle formed a trough. Now that 40-day cycle is very difficult to identify in the price action because, as you can see, price just pretty much headed straight upwards. That's not very unusual following an 18-month cycle trough, and it is one of the reasons why I like to position the 18-month cycle trough in the beginning of October, because that very strong move would seem to indicate that a fairly long cycle has turned around and is giving a lot of impetus to the markets. And so the market sort of took the ball and ran with it and just went up and up and up, and the 40-day cycle simply had no effect on the market at that time in terms of pulling the market down. But the more natural M shape would be that move over there, and then up to a second peak. So there's our second peak, and then a move down over there. So you can see there is indeed a very distorted M shape, but it is still an M shape. And so that is the cycle shape of the first 80-day cycle following the 18-month cycle trough at the beginning of October, according to this analysis. So what has happened since then? Well, since then we have, in my opinion, witnessed a 40-day cycle elapsing, and you can see that here is the nest of lows for the 40-day cycle trough, and that trough is now overdue. It really should have formed. Let's measure the number of bars that have elapsed. There we go, 38 bars up to yesterday's price action. You will notice this chart only includes price up until the end of the 10th of January 2022. So 38 days is ever so slightly long for a 40-day cycle. An average 40-day cycle is 34 days in length, and if you don't understand why the average length of a 40-day cycle is 34 days, I would encourage you to download the 10 core concepts of Hurst cycles document that I will provide a link to in the description below this video. And so the 40-day cycle trough is due, and so we have now witnessed a 40-day cycle shape. And so there is the move up. Here is the move down into the intermediate trough, which is of course a trough of the 20-day cycle. And then here is the next move up, and then the move down. In my opinion, the 40-day cycle trough has probably formed. In fact, one day we should really speak about candlesticks and the kinds of candlesticks that tend to form when troughs form, and that sort of pin bar where you've got a long tail and a very short body is the kind of thing that you do often see when trough forms. So it is quite possible that that 40-day cycle trough has formed. Of course, we would need confirmation of that. Nevertheless, if we take a look at these cycle shapes, you will see something fairly interesting occurring. And so let's focus on the 40-day cycle shapes. So where is the first 40-day cycle shape? It is in fact probably following the 18-month cycle trough. It is probably that over there. Can you see that's also an M shape? It's extremely distorted to the upside. Why? Because the market was very bullish at that time following an 18-month cycle trough. No big surprise. We expect the market to be bullish when a long cycle forms a trough. So we get a very bullish M shape for the first 40-day cycle. The next 40-day cycle is expected to be less bullish and might even be slightly bearish. So this M shape is what I call a mixed shape, because you can see that it ends slightly lower than it started, which is a bearish sign. However, the second peak, this peak over here, was higher than the first peak, this peak over here, which is a slightly bullish sign. So that's a mixed cycle shape. So we went from very bullish to effectively neutral for the second 40-day cycle. That's the kind of pattern that we expect to see, because of course we would have a bullish 40-day cycle followed by a neutral or bearish 40-day cycle, and then we should get another slightly bullish 40-day cycle because of the fact that the 80-day cycle trough has formed, or potentially a 20-week cycle trough. And then, of course, we're going to get a bearish, the most bearish 40-day cycle out of all of them. So, as I've already pointed out, here we have the next 40-day cycle shape, and it is a bullish cycle shape. So that's good news. That's what we expected. However, it is a worryingly not very bullish cycle shape, if you see what I mean. It did reach a second peak over here, but the bearish signs are beginning to appear in this market. And so even though I believe it is very likely that a 40-day cycle trough has formed, the next 40-day cycle is going to be what kind of shape? It is, of course, going to be a bearish, or I should say it is going to be the least bullish of all the cycle shapes so far in this sequence of cycle shapes, and it will probably be a bearish cycle shape. So that is what we have in store for us now. Let's take a look at some of the other tools to help us to understand what has been happening. And I'm going to start in this discussion with the VTL. And let's just focus first of all, well, here's an interesting VTL, the 20-day VTL. I don't often speak about VTLs. They are less reliable than the FLD. VTL is an acronym that stands for Valid Trend Line. FLD stands for Future Line of Demarcation, and these are two cycle tools that were developed or discovered by Hurst 50 years ago. It's extraordinary to think about that. But we use these tools to refine our analysis and to understand the analysis, and also to make trading decisions. The important thing about the VTL is that when price crosses down below an upward moving VTL, this is an upward moving VTL, a VTL has to connect two consecutive troughs of a particular cycle, and so this VTL connects the 20-day cycle troughs, two consecutive 20-day cycle troughs. When price crosses below the 20-day VTL, that would confirm that the next longer cycle has formed a peak in the markets. So price has not yet crossed below that VTL, so we don't have any confirmation there. But what is very interesting is the 80-day VTL, which there are actually a few things to say about this 80-day VTL. First of all, the 80-day VTL should connect two consecutive troughs of the 80-day cycle. You will notice that here the VTL is ever so slightly displaced below it. Why is that? Well, Sentient Trader does that, and it's a subtlety to the way in which Sentient Trader behaves. And it was introduced by me because I had been drawing VTLs for some time before I started developing Sentient Trader. And one of the rules to drawing a VTL is that price should not cross below the VTL. The VTL should be drawn in such a way that price does not cross below that VTL. And now an interesting thing happens if we were to draw the VTL in the correct position, which would be touching that trough over there, which is that the VTL would be ever so slightly higher, which would mean that it would be crossed at this position over here. So why don't we just let that happen? Well, when price crosses below a VTL, it confirms that a peak of the next longer cycle is in place, which would mean that it is confirming that the 20-week cycle peak is in place. Now, the 20-week cycle started over here, of course, and it is going to end at this nest of lows over here towards the end of January or early February. And so if by price crossing below that VTL, and I should point out that purists would call that a price cross of a VTL. I don't call it a price cross, but that's because I'm not such a purist when it comes to VTL action. But there are some analysts who would say that qualifies as price crossing the VTL. And so that would mean that the 20-week cycle peak was in place. And the highest price before that cross had occurred was this price over here. However, we have since had a higher price. And so we have a bit of a dilemma, because price, by crossing the VTL, is confirming that the peak has formed. However, we have had a higher price. So how does that work? Well, you could argue that the 20-week cycle did in fact form a peak over here, but in price, the other cycles and the influences of the other cycles have created a slightly higher peak over here. That makes for an interesting discussion. But what I prefer to do, particularly if the point at which price touches the VTL is still within range of being a possible 80-day cycle trough, I like to instead make the assumption that it is just possible that in fact the 80-day cycle trough only occurred over here, as opposed to it occurring over there. And so that is why this VTL is slightly displaced below the trough. It doesn't exactly match the analysis at the foot of the chart. It's usually a very subtle thing, and often you don't even see it when it does happen on the charts, and it doesn't happen very often, I should point out. But I thought it would make for a bit of an interesting discussion in terms of these VTLs. I started when I was drawing the VTLs manually with a pencil on my printed charts. I started noticing that kind of thing happening, and to avoid the dilemma of where is the peak, is it here or is it here, I would reposition the VTL slightly. Of course, it can only be repositioned after the fact, but nevertheless it gives us a slightly displaced VTL. The important thing is that the 80-day VTL has not yet been crossed, although, as I pointed out, purists might suggest that that does qualify as a VTL cross, and therefore the 20-week cycle peak is in place. So some interesting information from the VTL there. Let's take a quick look at the FLD, and you know, of course, that I usually track the 20-day FLD. Did I say FLD? We're looking at the FLD now, future line of demarcation. This is the 20-day FLD that I usually track following an 80-day cycle trough, and I'm going to go through this quickly because I'm sure you're familiar with it. We get a sequence where price crosses above the FLD and is expected to achieve its target. It slightly failed to do so, I believe. We then expect price to find support at the level of the FLD in a B category interaction. In this case, price dropped down below the FLD. That is not a failure of the whole FLD approach. It is interesting information telling us that there is some bearishness coming into the market, and price dropped down only for a few days and formed a very deep 20-day cycle trough over here. So that is a bit of a warning sign. It's telling us that there is some bearishness coming in. And then the C category interaction, which is usually a matter of price moving away from the FLD after having found support at the level of the FLD, in this case was in fact a cross above the FLD. Price did achieve that target, and so it looked as if though the bull was recovering, but it didn't go much beyond that target, and we have now had a further cross below the FLD, which is of course a D category interaction where price is expected to achieve its target, which it did easily, and drop into the 40-day cycle trough. Our next interaction should be when price crosses up above the 20-day FLD. That is an E category interaction, but we should bear in mind that we are now in the final 40-day cycle of a 20-week cycle, in my opinion, and the cycle shapes that we've been discussing today seem to corroborate that suggestion. Let's also now look quickly at the 40-day cycle FLD, because this whole interpretation of interactions between price and the FLD can be applied to any cycle's FLD. Well, not quite any. I should point out that when there is a 3-to-1 or 5-to-1 harmonic ratio between cycles, then you need to apply it slightly differently, but there isn't time to discuss that in today's video. Here is our A category interaction following a trough of at least 20-week magnitude, which of course we had in October. Price came up and easily achieved its target in that A category interaction. The B category interaction should form at the time of a 40-day cycle trough where price is expected to find support at the level of the FLD. Did price find support at the level of the FLD? It didn't get anywhere near the FLD, did it? This is the strong upward movement that followed the 18-month cycle trough that I mentioned earlier. Again, not a failure of cycle analysis, but simply an indication that there was excess bullishness in the market. Not a big surprise, considering that we had just experienced an 18-month cycle trough. And so our B and C category interactions are effectively impossible to identify. And I mentioned in a recent market update video actually that some people will identify that BC category interaction as price moving towards the FLD and moving away. Other people simply don't identify those interactions at all. And the next interaction is, of course, the D category interaction as price drops down into a trough of 80-day magnitude, because we are looking at the 40-day FLD. And that D category interaction easily achieved its target and extended below it, formed the 80-day cycle trough. The fact that it extended so far below its target was an early indication of some bearishness coming into this market. Then price crossed above the FLD in an E category interaction, and I believe it hasn't quite achieved its target yet. I haven't actually measured that carefully. We could measure it, but it doesn't look as though it has quite reached that target. Might have just. I'm sure somebody can correct me on that in the comments, but the point is, if it hasn't reached the target, then again that's some indication of bearishness. And this whole behavior shortly after crossing the FLD, where it struggled to get up off the mat, as it were, and came back and found support at the level of the FLD not once but twice, is an indication that the market is beginning to struggle. We had a bit of a Christmas boost, of course, the week before Christmas and the day after Christmas, I think. And we have now experienced the F category interaction, where price crosses down below the 40-day FLD on its way down to the 20-week cycle trough. What's going to happen now? Well, price is expected to bounce up, of course, having formed the 40-day cycle trough, and it is expected to find resistance at the level of the 40-day FLD. So I pointed out that we're looking for a bearish 40-day cycle approaching. And that's what I mean. The upside to the next 40-day cycle is expected to be limited by this 40-day cycle FLD. So I'm not feeling particularly bullish. You might have noticed I'm feeling a little bearish as price starts moving down into the 20-week FLD. Let's play around with one more FLD quickly before we take a look at Bitcoin. Here is the 80-day FLD. Following a trough of at least 40-week magnitude, we get an A category interaction where price crosses up above the FLD. And that A category interaction easily achieved its target and indeed exceeded it a little bit. At the time of the first 80-day cycle trough, because we are looking at the 80-day cycle FLD, we expect price to find support at the level of the FLD. Did it? Well, you might argue that it sort of almost found support. I often refer to it as approximate support. And it's important to bear in mind the time frame of your chart compared to the wavelength of the cycle that you're looking at. When looking at a daily chart, looking at a 20-day FLD, you have a good match between the time frame of the chart and the wavelength of the cycle. For an 80-day cycle, you are looking at a cycle that is slightly too long in terms of the time frame, the daily time frame. We could look at a weekly chart and get a slightly better match perhaps between the FLD and the chart. But the point is, as I'm sure you can see fairly clearly, that through a sequence of 1, 2, 3, 4 interactions, price found very approximate support at the level of the 80-day FLD. You need to sort of blur your eyes a little bit to see that as support, and I wouldn't really consider it as support, but the point is that at the time that the 80-day cycle trough formed, price was at roughly the level of the 80-day cycle FLD. It dropped below it, as you can see, on this occasion here and on this occasion here. And what does that mean when price drops below an FLD where it is expected to find support? It indicates that there is some bearishness coming into this market. And so I would label those interactions as B and then C over here. And of course, the interaction that we have just experienced is possibly an early D category interaction. It's also possible that because we're looking at an 80-day cycle FLD on a daily chart, it's possible that price is going to bounce back up again from the 40-day cycle trough and stay above the FLD and only actually cross down below the 80-day FLD a little bit later, in which case that would be our D category interaction. So this might be a premature D category interaction here. The important thing is that in terms of the 80-day FLD, the next sort of move that we're looking at is a move down into the 20-week cycle trough, which you can see is expected in early February, I guess you could say. Let's count some bars just to give us a slightly better idea. If we count the bars from the 18-month cycle trough, there have been 98 bars. Average length of a 20-week cycle is 136 bars. So we have about 38 days to go, according to that bar count. There have been 38 days since the 80-day cycle trough at the beginning of December. Average length of an 80-day cycle is 68 days. So we're looking at about 30 days there as well. And if the 40-day cycle trough did form yesterday, which is a little bit of a stretch, it's a bit premature. As you can see, there have been 0 bars since that occurred. That was a bit silly. But we would be looking at another 36 days elapsing before the 20-week cycle trough forms in the markets. So that's my opinion for the S&P 500. We're in the final 40-day cycle, and we have about 30 to 36 days to go until a 20-week cycle trough forms. Let's take a quick look at Bitcoin. So here is the analysis that I've been looking at for several months in Bitcoin, and the important sort of feature here is the fact that the 18-month cycle trough occurred in the middle of July, and I've discussed this in previous market updates about Bitcoin. It's one of the reasons why I was quite keen to consider the middle of July as an 18-month cycle trough for stock markets as well, because of the principle of commonality. Many markets move with a great deal in common. So you can see I have pinned this. There is that pin symbol again. I've positioned that 18-month cycle trough over here because that makes a better definition for a trough, in my opinion, than this low price over here, which is actually a slightly lower price. And that is where Sentient Trader would like to, by default, position that 18-month cycle trough because of the slightly lower price. And we can take a look at that in a moment. But in my opinion, the cycle trough is better positioned over there. In my previous market update about Bitcoin, I was discussing the probability that the 20-week cycle trough had formed over there with the strong move down. But of course, as a friend of mine pointed out recently, if you take a look at the line on close chart, this 20-week cycle trough hardly shows up as little more than a little blip in the downwards movement. And so it would seem likely that price is either still moving down or potentially formed the 20-week cycle trough over there just a couple of weeks later, not even 2 weeks later, than the position we have at the moment for the 20-week cycle trough. The important thing really, in my opinion, is that we are now coming into a 40-day cycle trough. As you can see from the bar counts over here, there have been 38 days, 38 bars since this 20-week cycle trough over here that was the beginning of December, I think. And so 38 bars, average length of a 40-day cycle is 34 bars, so we're a few days overdue. But in my opinion, we are due for the 40-day cycle, and for the 40-day cycle trough, I should say. And we can count bars from here, even if we displace the 20-week cycle trough over here, as pointed out from the line on close chart. 25 days have elapsed, and so we would be looking at the 40-day cycle trough forming fairly soon. Perhaps we have 9 days left. And if we count the number of bars, you can see that this 20-week cycle trough formed at 137 days after the middle of July 18-month cycle trough. Now, the average length of a 20-week cycle is 136 days. That is the average length that Hurst found 50 years ago. And that kind of thing gives me warm, fuzzy feelings to think that a cycle wavelength discovered 50 years ago can be seen to still be playing out and influencing the price movement, particularly the price movement of a market like Bitcoin, which is considered by many people to be a very different market to traditional stock markets. But in fact, it certainly seems to be influenced by the same cycles. So what is happening here? Well, the subject of today's video is really talking about cycle shapes. And so let's speak about the cycle shapes. If the 20-week cycle trough did form over there, then what's happening with the cycle shapes? Why is the market kept going down? What is happening? So let's zoom in and take a look at the cycle shapes here, and let's draw from the peak over here. I'm not sure why that is displaced. I think I was testing the data and displaced the data accidentally. So if I draw the cycle shape, and we are looking now at the peak analysis, let's not worry too much about the trough analysis just now. So we have a cycle shape here for the 40-day cycle. So there it is, and it comes down into the trough, and then it comes up into that peak. So of course, because we're looking at a peak synchronized analysis, instead of finding M shapes, we expect to find W shapes in the market. So that's an interesting little variation on the theme. So what has been happening since then? Well, since then we have seen another 40-day cycle shape play out, or at least sort of 3/4 of it, and we are now expecting a bounce up to complete the 40-day cycle as it comes up into this 80-day cycle peak. So what am I expecting for Bitcoin? I'm expecting a bit of a bounce, but there can be no denying that the Bitcoin price has also turned bearish. If you look at these cycle shapes, we had a strongly bearish cycle shape for the first 40-day cycle. Not a big surprise, given that, as discussed in the previous market update video, it seems likely that this peak was of at least 18-month magnitude. There is the possibility it could have been a 54-month magnitude peak. I don't want to frighten you, but it is possible. But we don't have enough evidence for that yet. Nevertheless, it was a fairly important peak, and so it's no big surprise that the market has turned bearish. One of the problems with performing a dual analysis, as we have on this chart, a dual analysis is when we have two separate analyses. There is an analysis at the foot of the chart, analyzing on the basis of the troughs being synchronized, and an analysis at the top of the chart, analyzed on the basis that the peaks are synchronized. When you have a dual analysis, the tendency for many Hurst cycle analysts, and I'm one of them, is to focus very much on the trough analysis, because that's my comfort zone. I'm used to looking at troughs and trough analyses. Peak analyses tend to just be a little confusing, frankly, quite a lot of the time. So there is the danger that you're focused too much on the trough analysis, and particularly in terms of, okay, a 20-week cycle trough has potentially formed, so therefore surely the market must go up. Well, yes, the market must go up, but don't forget that if it is dropping out of an 18-month cycle peak, the amount by which it goes up is not likely to be very impressive because of that great pressure from the peaks. And I have an interesting demonstration to give you here in terms of understanding the way that these two different analyses represent the ways in which the cycles are influencing the price movement. And that is by displaying the composite model line. Here is the composite model line for this particular analysis. Just a reminder, the composite model line takes the information from the analysis. So it is based upon the analysis. It's a little bit like a mathematical conjuring trick in the past, because you're taking a price action, you're analyzing it, identifying the cycles, extracting the cycle information, and then recombining that information to produce the composite model line. It's a mathematical conjuring trick when you're looking at the past, because you're taking a number, performing various operations on it, and ending up with a very similar number. So what the composite model line effectively tells us is that if the only thing influencing this price action were the cycles that have been found in the analysis, then this orange line is what would have happened in the past. What's the big use of the composite model line? It helps us to explore the analysis on the one hand, which we're going to do in a moment, but it also gives us very interesting and useful information about the future. Because cycles beat with a fairly regular wavelength, bearing in mind, of course, the principle of variation, which tells us that that wavelength varies all the time, but because they beat fairly regularly, we expect them to continue beating, and the composite model line is giving us that information. But now there's something else that's really useful about this composite model line. Because I have two analyses on this chart, the composite model line is a composite of both analyses. So what we can do, if I display the information about the composite model line, these are the cycles that are included in the generation of the composite model line, starting with sigma L all the way down to the 20-day cycle. And you can see that this composite model line includes troughs and it also includes peaks. Now, look what happens when I do not include the trough analysis in the composite model line. Do you notice what is happening particularly over the most recent time? The peak analysis is defining very clearly and very well what has been happening in this market recently. And that is really useful information. In my previous market update videos about Bitcoin, I've pointed out that over time I keep changing my mind about which is the dominant analysis. Perhaps dominant is the wrong word, but which is the more critical analysis. Is it the peak analysis or is it the trough analysis? And I think it might even have been in my last market update video, I spoke about the fact that the trough analysis was looking very good in my opinion and had been beating very regularly. But this composite model line, based only on the peak analysis, shows something really quite interesting. During this period of time, the composite model line is not matching very well, indicating that indeed the trough analysis was probably the more accurate of the analyses. It was the better analysis at that time. But what has happened since about the end of September last year, I think you can see for yourselves, it is very clear that the peak analysis is giving us a much better interpretation or much better insight into what this market is doing. And so the peak analysis is certainly one that I am focusing on. Does that mean that I totally ignore the trough analysis? No, not at all. I am expecting a 40-day cycle trough to form, and I'm sure that we will witness one forming fairly soon. But in terms of the peak analysis, the next big event is going to be price forming a trough over here and then moving up into the 20-week cycle peak over here, which is expected towards the end of February, I would say, that next 20-week cycle peak. So we might still have a bit of downward movement coming down into this trough over here before price climbs up into the 20-week cycle peak. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.